Hello everyone, welcome to another lesson. I'm Ali, and in this lesson we will look at evaluating fraud risk. Per ACCA 240, fraud is an intentional act to obtain an unjust or illegal advantage through the use of deception. During the risk assessment phase of the audit, the auditor must assess the risk of a material misstatement due to error, management bias, or fraud. Auditing standards require that an auditor should adopt an attitude of professional skepticism during the audit. This means the auditor should be maintaining an independent questioning mind. That means the auditor doesn't take information at face value. Suppose if you are an auditor and if you are looking at the information, then you need to evaluate, does this make sense? Does this look authentic? Does this fit with what I am expecting of the client? You should search thoroughly for corroborating evidence to validate information provided by the client. How you can do so? You can do so by obtaining evidence in an unbiased manner, which will help you to identify potentially contradictory evidence as well as to confirm the evidence. You must not assume that your past experience with client management and staff is indicative of the current risk of fraud. While assessing the risk of material misstatement due to fraud, firstly, the auditor considers the potential for fraud during the current audit. The auditor can use red flags to alert them to the possibility that the fraud may have occurred, such as high turnover of key employees, a high staff turnover, which can in turn lead to the scenario of understaffing in the entity. Understaffing in the entity is an important factor contributing to fraudulent activities. The understaffing can in turn cause a breakdown in the control system of the organization, thus making it easy for fraud to occur. Key finance personnel refusing to take leave. This can be because the fraudulent finance personnel may worry or may be concerned that their activities may come into light in their absence. Overly dominant management. When a single individual is in a position to dominate the decisions of the management team, and especially when the board of directors is weak, this individual is more likely to engage in an unsuitable behavior. As a result, there is a high chance of fraudulent activities in the organization. Poor compensation practices can lead to dissatisfaction among employees. Dissatisfied staff may engage in fraudulent activities. Inadequate training programs, complex business structure. No or ineffective internal audit, high turnover of auditors, the transactions or activities are undertaken at an unusual time, weak internal controls. In any organization, if the control system is weaker, then it makes it very easier for fraud to occur. There are two types of fraud. The first one is financial reporting fraud. The financial reporting fraud is intentionally misstating items or omitting important facts from the financial report. The second kind of fraud is misappropriation of assets fraud, which generally involves some form of theft. It is the responsibility of those charged with governance to prevent and detect fraud in the organization. However, it is the responsibility of the auditor to assess the risk of fraud and the effectiveness of the client's attempts to prevent and detect fraud via their internal control system. When assessing fraud risk, the auditor considers three conditions that are generally present when fraud occurs. The first one is incentives and pressures faced by their client to commit a fraud. The examples of incentives and pressures that increase the risk of fraud are: the entity operates in a highly competitive industry, a significant decline in demand for the client's products or services, falling profits, a threat to take over, a threat of bankruptcy, ongoing losses, rapid growth, low cash with high profits, pressure to meet market expectations, planning to list on a stock exchange, planning to raise debt or renegotiate a loan, about to enter into a significant new contract, remuneration tied to profit, for example, bonuses or options. The examples I just explained indicate that a client may be inclined to committing a fraud. There's no way to indicate that a fraud has definitely occurred. However, when the auditor becomes aware of any of these risk factors, they will plan their audit to obtain evidence in relation to each of these risk factors. The next condition is opportunities available in the organization to perpetrate a fraud. After identifying one or more incentives or pressures to commit a fraud, an auditor will assess whether a client has an opportunity to perpetrate a fraud. For this, an auditor uses their previous knowledge of how other frauds have been perpetrated to assess whether the same opportunities exist at the client. The examples of opportunities that increase the risk that a fraud may have been perpetrated include such as accounts that rely on estimates and adjustments, a high volume of transactions near to year end, significant adjusting entries and reversals after year end, significant related party transactions, poor corporate governance mechanisms, poor internal controls, high staff turnover, a high turnover of staff, the same as above, reliance on complex transactions, transactions out of character for a business. For example, if a client leases its motor vehicles, they should not have a car registration expenses. I'll stress out again here that the examples which I just explained suggest that a fraud may have been carried out, but their existence does not mean that a fraud has definitely occurred. Together with the identification of incentives and pressures to commit a fraud and opportunities to perpetrate a fraud, an auditor will assess the attitudes of client management and staff to fraud. Attitudes are ethical beliefs about rights and wrongs, and rationalization refers to an ability to justify an act. The examples are such as the implementation of an effective internal control structure is not seen as priority. A poor tone at the top, that is from senior management. Tone at the top refers to upper management and the board of directors' commitment to being ethical, showing integrity and being honest. A poor tone at the top results in a company that is more susceptible to fraud. There is an excessive focus on profit maximization or on increasing the share market price. A poor attitude to compliance with accounting regulations. A rationalization that other companies make the same inappropriate accounting choices. And in the next video, we'll talk about going concern assumptions. Thank you.